Hey, hello everybody. Today is Monday, 9:51. Today is holiday, February 19. So just to review the market wrap that I wrote on Friday. Something that I want to highlight is the economic agenda is not too busy, especially tomorrow. So the most macro events supposed to be happening on Thursday and tend to affect TNX and DXY. And of course, if it came like worse than the economics expected, we supposed to be see DXY and TNX going down and consequently the risk assets going up, right? So the busy agenda is not too much as was last week, but the busy day will be Thursday. Okay, the busy day will be Thursday. So what happened, in the OPEX? So you guys already realized that the GX dropped almost $3 billion, so they start to accelerate the markets. But in another hand, the DIX jumped 1%. So what this mean? Liquidity was added and dealers was willing to buy, not to sell. Okay. I also highlight to you guys in the closed group. So last week they set up the minus GX at 4,950 and the plus GX at 4,050. Consequently, they collect money from both sides, from short sellers and from long, from bull and from bears. And at the close, at the OPEX closed exactly in the worst case scenario that was 5,005. Okay, so after the close, what do we have, in the book? Of course, it's updated after the in the day after, right? Because CBOE takes, a couple hours to update the options book. So what I highlight to you guys, overall delta flow is bearish because it's negative. The delta support is supposed to be 5K. She basically, we have a lot of put open interest located at 5K. So 5K is a main support per delta, right? And what delta was telling us on Friday, squeeze is supposed to be start above 5,020, right? Supposed to be start at 5,020 and the inflection point supposed to be 5,025. This is what we had in the book on Friday. Let's check the gamma design. Okay, what do we have in the book in the gamma design? So we have like a defense at 4,900. In 5K. So I like to call like data divergence because you have positive gamma at 5K, but we have negative delta flow at 5K, right? Because that 5K is very important level according book on Friday. Okay, so in the options book, as I told you guys, especially the CPCI that jumped to 1.33, the SPY put call rates jumped to 1.4. But in another hand, according CBOE, our orders put call rates is low. So basically, people are very long in stocks, but they are hedging through index, right? And index ETF such as SPY. Okay, I didn't check QQQ. So since we have divergence in the book, of course, the pattern, the structure, the dynamic left on Friday was bearish. I cannot came to you and said, oh, it's bullish. It's not. The dynamic is bearish. Also post to you guys the volatility skew, right? On, I guess was yesterday or Saturday. The volatility skew on Saturday, you can see, out of the money calls implied volatility has a very huge drop, and the out of the money put had a very huge spike. How we call this volatility skew pattern? We call it SMIRC. Okay, the correct thing you know, the balanced market is to see a smile. Okay, let me get a draw, and then you guys understand. What's mean a smile? Smile means that the same delta levels, okay, same delta levels. Imagine you have like 14 deltas over here, and minus 14 deltas over there, and 14 deltas over here. They supposed to be have the same implied volatility. Imagine you have like 10 deltas over here, right? Minus 10 deltas over here. We supposed to be have the same implied volatility as plus 0.10 deltas, and so on. This we call a smile skew. So it's a balanced market. When you have a smirk, we could be something as you saw here. Okay, so higher implied volatility in out of the money put contracts and lower implied volatility in out of the money call contracts. What this mean? People, at least last week, you know, they started to sell calls, out of the money calls, to finance themselves to have to buy out of the money puts. Why? Because higher implied volatility means higher risk, higher premium. Okay? Higher premium. And of course, it makes sense to see a screen like this on Friday, on Saturday, because we saw a drop from 5,035 up to 5K and then close at 5,005. So everybody is expecting a drop this week, right? At the close, we saw basically, you know, everybody, you know, expecting a drop for this week. Okay, you guys understand, you know, the volatility skew. So on Friday, we had higher implied volatility out of the money puts and lower implied volatility in out of the money call contracts. Means that market participants is expecting a drop. Okay, let me remove this from the screen. I also hope you guys understand why, you know, a smile volatility skew means, you know, a balanced market. And now, what do we have in the volatility skew right now? Let me get my Thinkorswim. Give me 1 second. So what do we have right now? Look at the spike at 5,010. So now it's totally different than yesterday. Sorry, not the yesterday, it's different than Friday. Because now the volatility skew for 30 days, I filter for 30 days up to March 20. Okay, now market participants, remember, today's holiday, only machines is working, not human being intervention. Remember that machines know how to calculate the premium faster than us because they already have all the algorithms. Okay, they already have all their algorithms. So what, you know, the volatility skew is showing to us right now, different, you know, than before, that we expect, you know, market participants expecting a drop. Now the volatility skew, since we jump the out of the money calls, because here is in the money, here is out of the money, and here is in the money puts, out of the money calls, right? And exactly here 5,005 is exactly is in the money. So now look the spike that you have in 5,010. Remember that before was totally different, was the opposite, was like this, you know, from out of the money puts, big drop to out of the money calls. It's still a smirk, but now from a bearish smirk to a bullish smirk. So what I've told you guys in the market web, and also makes sense what we are seeing, because you know what I highlighted to you guys in the market web, and consequently, you know, in the and also in the closed group. So for me, that's my personal opinion, my personal analysis. Again, the book left on Friday, right? And the flow was bearish, the structure was bearish. It started to change. But what I highlight to you guys, usually CPCI, you know, much more retail trade means the CTAs are also retail, okay? Because, you know, dealers are totally long gamma. So they short future, they sell future, they hedge themselves through future, okay? They hedge themselves through future. So when you see a spike in CPI, usually is retail or hedging or shorting. So we never know. But the spike in CPCI, the spike, you know, the put call ratio spike, and now orders, you know, in ETF, my interpretation was, you know, people expecting a huge drop and they start to short the market. And I also highlighted what we saw last week because everybody was expecting a crash and dealers set up the minor GX at 4,950 and the plus GX 5,050. As I said in the beginning of this video, you know, they call it, no, sorry, they collect premium from bulls and bears. And since the GIX jumped 1%, you know, my interpretation is they were willing to buy cheaper. They bought at 4,920 and they bought at 5K, especially on Friday. Okay? And they removed the GX. They add acceleration. Means now to move 1% markets not need more $6 billion. Now they need only 3.6 billion. Basically, this is the meaning of the GX. When they, you know, drop the GX, this GX, you know, this is not, you know, the gamma in the book. Okay, it's a different GX. So to move the market right now, they don't need more $6 billion. They need, you know, half of the money that is needed before. That we call market acceleration. So we already saw the delta flow that left you on Friday, 5K. Exactly, you know, exactly will be the support, delta support and gamma support. Inflection point for the upside 5,025 and squeeze start at 5,020, right? Gotcha? So this is what we have. And the worst case scenario is supposed to be something between, you know, 4,990 and worst case scenario 4,975. That, you know, what we had in the book on Friday. Okay? I also highlight some fractal in the book. So exactly what has been happened, you know, before the VIX expiration and after the VIX expiration. They drop, gap down, they buy the dip, spike the volatility, they start to suppress the volatility, make market calm, and then market is healthy again to go up. And look like the fractal is almost the same. You saw buy at the dip, start to go up. We saw our OPEX over here as well, going down, buy the dip, close at worst case scenario. I'm expecting a small green candle tomorrow and market will be healthy to go back up, maybe back test 5,006 per fractal. Okay? Now let's look for the TNX and the XY. The TNX, as you guys see, you know, we saw a jump to backtest this pivot. So it's good to see now, you know, it's going down. What make this going down? Exactly Thursday. Thursday, the initial jobless claim, if it come worse than expected, we will see the TNX and the DXY going down. What this means, risk assets going up, and then you could see this again. Okay, and the DXY, the dollar index, looks like that's forming a head and shoulder. That's a bearish picture. That's a bearish pattern. Okay, look that you saw two rejects already at the inflection point at 104,699. That's the purple line. It's already rejected two times. Rejected two times. So it's good to certify that this pattern will be built is if you start to see going down. Okay, it's going down. The support of the dollar is around 100 points. Okay, so since I already reviewed the market trap, I also post what I did for Monday. I sold a put spread because I sold like a vertical. I sold 5,010 and I bought 5,005 and I received $2.65. So I'm expect to receive the full premium to see market on Tuesday tomorrow closing above 5,010 and see deltas corroding, theta corroding out the premium, and I supposed to receive the full premium, right? The full premium that I received 265. That's what I have for Monday. Okay. Anyway, we already reviewed the entire market trap. We already reviewed the structure, bearish flow, 5 cases support, 520 start to squeeze. That's what left in the book on Friday. Okay, let's close the market trap and check what the robots have been doing right now and what we suppose we could expect on Monday. So only robots are operating market today, not human being intervention. The delta flow now became positive, bullish, but it's really low. It's really low, but give us some clue, what's going on, what will going to happen tomorrow. Okay, look at the difference of the gamma. Now we are in a negative gamma territory. What's happening in a negative gamma territory? Squeezes, right? Why? Because everybody is playing negative delta. So as soon market starts going up, to start to flip for a positive gamma, they need to neutralize their portfolio, causing a gamma squeeze, right? Negative gamma pattern is sell weakness by strength, different than positive gamma. Positive gamma pattern is sell strength by weakness. Okay, so different than yesterday. Look now that 5K has a negative gamma, different to what they left on Friday, right? We start to see positive gamma at 5,025, same level that we saw on Friday as an inflection point, right? But before we looking for 5,020, 5,020 as an inflection point. Now, per volatility skill, tend to be 5,010. Why? Because they spike the implied volatility in such contract, in such strike. What's going to happen as soon as you break 5,010? Call sellers, because on Friday the skill is different, the drop was for the out of the money call. So people sold call to buy puts. So those that sold those calls need to buy back and neutralize deltas and causing a gamma squeeze. So now instead of 5,020, now we have 5,010 as a region that the squeeze will start to happen. So the book right now is totally different than the book what we saw on Friday. Delta start to be positive. The gamma now is not in more a positive territory. The gamma now is a negative territory. That's a good setup to see a squeeze. That's a good setup to see a squeeze. And market participants today, tend to be selling out of the money puts to buy out of the money calls, especially because out of the money puts on Friday were much more expensive, right? And now is reflecting the volatility squeal. Okay, but I cannot lie to you guys. We have a bearish book, but it's a good setup to see a squeeze, especially because we have a calm agenda. And market participants on Friday were willing to buy negative delta, not positive delta. Okay, so guys, I'm finished by here. So we have like a big flip in a volatility skew. Also, we have a big flip, in the gamma design, and consequently in the delta design too. Look the spike in delta flow at 5010, but remember, it's not something that you need to be like impressed, because it's just machines displaying today. It's like a no volume day. Okay, so instead of 5020, before was 5020, the squeeze supposed to be starts, now is 5010. They drop 10 points, but 5025 is still, the inflection point for the upside. Since we have positive gamma over here, we could see a rejection at 5025. I cannot disregard, a rejection at 5025. Breaking up 5025, 5025 per gamma tends to be the new support. Okay, guys, take care, enjoy the day.